We follow the multifamily trends very closely because multifamily is the core. It drives everything real estate wise. And multifamily and storage is so closely correlated together that we have to understand that.
Welcome to Multifamily Insights. I'm your host, Johnny Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, do me one little favor and leave us a rating and review. It helps other listeners find this show. It also helps us know what's working hard for you and maybe some things that we can work on to make it work a little bit better. And if you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Stewart Heath. Stewart Heath is the founder and CEO of Harvard Grace Capital, a private equity real estate investment firm that helps people build wealth faster through hands-off real estate investing. Now, they are located in the Tennessee Valley. Let's welcome to the show, Stewart Heath. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today.
Thank you so much for having me. I really appreciate it.
Absolutely. Hey, Stuart, I went over your bio at a very, very high level. Why don't you take 2 minutes and give us more context on your background?
Sure. First, I am a CPA. I sort of grew up in a family of CPAs, and just sort of went to school and thought that's what people did to make a living, and did it for about 20 years. And I don't really like this, so I started mimicking what some of my clients were doing. I had a lot of fix and flippers and buy and hold guys, and saw wealth being generated, not overnight, but wealth being generated slowly and surely, and for the most part in a passive way. Once you actively get your real estate positioned, then it can be passive for you. And so followed that, got really heavily invested into real estate, and I've done development and construction, and just in all honesty, didn't make it out of the great recession in whole. But I don't blame the real estate for that. I blame myself for that, and have come back and approaching the real estate investing in a very different way. And it's being very successful right now. So
Yeah, I
happy to be
love it.
here.
I love it. Well, listen, you gave some really good insights on your background, right? So CPA for 20 years. I had to laugh a little because you said, after 20 years, you realized you really didn't like that. And
Right.
it's one of those things I'm sure a lot of listeners can identify with, right? You go through a career, you do what you got to do, right? You do what they tell you. Go to college, get a good job, you work that job. And at some point, for you, it was 20 years down the road, you realize, I really don't want to do this anymore. And I think it was interesting that you looked at some of the things your clients were doing and realized, you know what, these people are making a lot of money in real estate and they're growing their portfolios. I'm seeing their tax returns grow every year, right? Or at least the amount of income they're bringing in. So that kind of sparked you down that path. You lost a lot in 2008, learned your lessons, and kind of came back even stronger. Let's go back though to that moment, right? You're a CPA, you're working with your different clients, and you realize that this isn't really what you wanted to do. What was it like kind of processing that information and finally getting and I don't know if it was courage or what that first deal looked like, but how did you go from kind of the mental acknowledgement of this isn't what I want to do to practically putting something in action to make that transition?
Um, that's a great question. Actually, I was my epiphany moment, if you want to call it that. Um, I was in the middle of tax season, so it's like 2 o'clock in the morning, and I just got up to decompress a little bit, and I'm turning on the TV, and there's this old infomercial guy who, if you're old enough, you remember him. His name's Carlton Sheets, And then he had a course called No Money Down. And I've been seeing these commercials for 10 years or whatever at this point. And, it was $199 money back guarantee, so heck, that's what X client is doing. I can do that. And I really had to have sort of a mindset change, because when I was coming up, I got out of college in 85, and in 86, we had this massive tax reform act, which did a number on real estate limited partnerships, tax shelter partnerships, just did a number on them, and had a depressive effect on the real estate industry for a time. And so I sort of grew up in the industry thinking, oh, real estate bad, real estate bad. And I remember hearing bankers say, we don't loan on real estate anymore. And how silly and foolish that was. I mean, it was just a structure that was bad. It was a tax law that was bad, that allowed abuses. And then they fixed it. If you remember the controversy, retroactively, they passed that act on October 6th of 1986 and made it retroactive back to the first of the year. Like, whoa, that's rarely ever happened. So, I mean, it had a massive impact to a lot of people. So anyway, I come through and I have to change my attitude that real estate is not bad. I have relatives who've done quite well with real estate over the years, and I was aware of this. But anyway, watching this infomercial, and I order Carlton Sheets' book. I still have it, and I start listening to the tapes and following his steps. And one of his rules, one of his recommendations in the courses, if you're not embarrassed by your first offer, then you're offering too much. And I have used that rule over and over and over and over again. And you might discount them because of an infomercial, but it was really, really good, sound quality advice. And I've continued to use it. But I followed his steps. Back then, we actually still had newspapers. And so I opened up the classified ads, and I found a duplex in my hometown that was for sale. And I went and met the seller and talked him into some seller financing and bought my first duplex that way. So, and that's how I got started.
What do you think it was about that particular night where that Carlton Sheets infomercial? I'm sure you had seen it, like you said, 10 years, so probably hundreds of times, right?
Yeah.
What was it about that night where it just clicked and you said, you know what, let me go ahead and order this?
Well, I was exhausted for one. And I realized, I wasn't getting any younger. And there was something about, I couldn't keep working, 18 hours a day. It's not a scalable model. As I already said, wasn't all that interested in my accounting practice anyway. So I really wasn't interested in hiring staff to sort of build that out as a business. It wasn't really a business model that appealed to me. So it was just the realization that you got to do something if you're going to actually build wealth, because you really can't get rich selling your own time. You can get rich selling other people's time, and making a margin off of that. But that wasn't what I wanted to do. So it was just the realization that you had to get in the game, as one of my mentors called it.
Yeah, I think it's interesting too, that pain point has to be strong enough. And for you, I'm sure 2 o'clock in the morning, you've probably been working, 12, 18-hour days, in tax season for some nights there in a row. And you were like you said, exhausted, and that's your tipping point. And when you saw that, you said, okay, here's a solution. Here's a possible solution. I need something else. And let me go ahead and take a shot at this. And, for all of us, there has to be a trigger. There's a trigger moment that makes you move forward with something that you've been thinking about. And it doesn't have to be as drastic as, you being exhausted at 2 a.m, or, sometimes you'll hear people, for me, it was almost facing eviction, and it wasn't really an eviction as much as it was we were looking to invest in real estate. Kind of like this property, not really, but I was renting and my lease was coming up and I was trying to, negotiate an extension with with the landlord. But his wife was pregnant and she basically told him, nope, like whoever is going to be here needs to be here for the next year because I don't want you dealing with this once I have this baby. So he basically told me, you either sign a year lease or you got to get out. And I'm like, oh, I guess we got to find a place to live then. So that kind of made me go and actually look at those properties more seriously. And we ended up putting an offer in and getting one. But, sometimes you need a trigger, you need a push to make you say, you know what, I've been thinking about investing for a long time. Let me move forward right now and just, see what happens. And I think that's a great thing. Now, we obviously don't want to be guessing and hoping it works. You had Carlton Sheets, we were house hacking our first deal. Talk to me about some of the ways you protected yourself going into those early deals to make sure you were making solid investments.
Well, being a CPA, my perspective on real estate is rather nuts and bolts. It's dollars and cents. And Sheets did cover this in his course, but I didn't exactly need his. I'd been helping clients analyze investments for years at this point. And real estate's really nice because they're relatively simple to analyze. And if it's income producing real estate, that is. And so it was very natural to me to sit down and say, all right, here's the rent income, here are the operating expenses. You got your taxes, your insurance, your maintenance, and your management expenses, the four main categories. And you try to play around with inflation factors. You study each. Is all right, what's going to happen to these? Insurance will likely change after you buy it because what they're insuring it for is probably, you just increased the insurable basis by the transaction you did. Same thing's going to happen with taxes. They'll raise your taxes up to whatever the transaction value was. So you got to account for that. And then you come down and see if does it cash flow or not. You get your calculate your net operating income and take your mortgage payment out of that. And gee whiz, do I have to feed this thing or is it going to feed me each month? It's really as simple as that. So that came very natural to me.
Yeah, I love that.
I've always had comfort in the numbers. So
that makes a lot of sense, especially given your background. I think that's another great insight, right? Is leverage the skills you already have when you're starting to get into a space. And I'm sure that, from a construction standpoint or things like that, did you take on that work yourself or did you identify people who could take on those jobs?
I have come to where I hire people to do jobs that they're the best at. After I did that first duplex and a few others, I decided to try my hand at doing a flip, and found a good property, had a good plan, but thought, well, I'll just do this myself. Well, I'm still practicing as a CPA. I mean, I'm still, and and the flip actually took me like 18 months, maybe 15 months. And after all, I figure I didn't make money on it, but I figure I made about $1 an hour, on the process. I said, yeah, this is not for me. So, fortunately I didn't lose my shirt, but I learned a good lesson there. And had I hired a contractor, which is the hard thing that everybody needs to go. Had I hired somebody and turned that thing in 90 days, I would have been selling in a different market than I ended up selling at, and who knows, my career might have been different after that. I might have made so much money that I would have just kept on going. But my whole nature is more of a buy and hold kind of a person anyway. I was sort of wrestling with myself the whole time. All right, this would make a great rental, and it would have, but I wanted to go ahead and flip it, and we did. So
I think there's a great insight in that though, Stewart, right? Because you have to understand your investing philosophy. And when you're starting out, you don't know, right? You don't really know what your investing philosophy is, but in hindsight, it probably makes sense, right? You're a full-time CPA, you were getting into real estate, you were looking for more passive income. And that flip project where you were running it, it was another job. It was a
Yeah,
project that required a lot of your attention. And that really wasn't the best investing strategy for you. And for
right.
anyone who has a full-time job or demanding schedule, you got to ask yourself, well, what kind of real estate do you want to do? Because if it requires, you to be on site, whether even if you have a contractor, I mean, those flip projects, you got to be precise with the timeline. You got to be on
Yeah,
site. You got to make sure the crews are there. You got to make sure the work is going. I mean, it's a lot of real-time decisions
a
that are
lot of
taking place every
decisions.
day.
Yeah, a lot of decisions in a remodel and a flip that you don't have in new construction. New construction, it's easy. Yeah, you're just going forward. In a remodel, it's like keep it or not keep it, keep it or not, and a lot of times if you're going to keep it, then it needs repairs. I mean, yeah, you're right.
Yeah.
It was not right for me. So
And I think the key, and we had the same issue, man. We did a flip project, and it was just a nightmare. And I was working full time. I had two little kids, and I'm sitting there trying to figure out, okay, if I leave here at 3:45, I can get there, meet with the contractor, do this, and then pick up my kids by 6:30. And it's just like I was just spinning the entire time, right? And trying to grow this business. So what I realized is that just wasn't the right investing strategy for me. It didn't fit my risk tolerance. It didn't fit my skill set. What was better for me was more of these income producing properties where I
right,
can manage them properly. I can run them like a business. I can take my business background and apply it
right,
versus again trying to argue with a carpenter on why the flooring
right.
is $1.22 a square foot instead of the quoted price of
Yeah,
$1.08 or whatever it is, right?
yeah,
That's just one of the things where I realized, okay, not really the best use of my skills. So let's fast
yeah,
forward, right? You said something
yeah,
else that was really intriguing. You mentioned that you lost a lot in 2008 with the last recession. You didn't blame real estate. You learned your lesson and kind of rebuilt from there. What were some of the lessons you learned? Because I think a lot of people are looking at the current economy and anticipating kind of another recession or at least a setback. So, what are
yeah.
some of those lessons you learned from that last downturn?
Well, I have a tendency to always want to go real fast. Um, Not so much in my older days, but back then, once I found something, I figured out how to do this. I just, I wanted to go fast, so I bought one duplex. My very next deal was a package of 14 duplexes, um, eh, which were great properties. And then I kept going. And then I found a package of 15 condominiums in a condominium. I bought those. I ended up buying every other condominium out of a total of 72 in that complex. And what I was doing was I was just back in the early 2000s. The economy was going up. Property values were going up. Um, as property values went up, I would refinance, pull cash out, go do another deal, and what do they call it, equity stepping, whatnot. Had a lot of banks who were just more than willing to help me do all of that, and I come back that I'm the CPA. I know better here, and I was in the middle of rehabbing those 72 condos, and and it was a pretty good strategy. My timing was off because we rehabbed them. Some of the big guys were in that same area of town and building new stuff, and they were selling out every weekend, whatever. And we had the first building ready to go in early 2007 of 24 units, and I sold 26 units in one weekend. So I'm
Wow.
like, this is great. I'm going to be out of this thing in a year. And I, would have pocketed several $1 million, and so that was 2007, going into 2008, and if I've got my years right, I didn't sell another one for over a year.
Wow.
And so we sat there, and of course, interest carry will kill a project like that without the sales. And so it was too much debt, going too fast, not enough reserves. And it really all comes down to reserves. You have to do the what if analysis as to what happens when everything goes bad. And so I had built a fairly substantial net worth on paper, at least, and but I had very little cash, very little reserves, and had I had reserves of as little as 300K or as much as 500K, I could have probably carried the entire period and still have some of those assets. These were some great assets, but I didn't. I was living on the edge, and like I say, with a lot of willing bankers. And so I don't do a deal now without reserves to carry the project for 24 months in case it's a bit extreme, and I get criticized for it, but you assume the property goes to zero income for 24 months, and what do you need to carry the project? That's your reserve number. Is that likely to happen? No. It's not unlikely that you might have to do that for 6 months.
Stewart, do you do that on
yeah.
all projects or just like development or?
I don't do any development right now. I do this even on my stabilized cash flowing projects, which is what we focus on right now.
All right. So just to play that back, you're saying one, you had this sounds like a great deal, 72 condos that you were selling off. You sell 26 one weekend and boom, it just dries up and you aren't able to sell any after that. Your lesson there and the insight there is make sure you have proper reserves. If you have reserves, if you have cash just sitting there, you can weather the storm of the economy. You can navigate through that. And I think it's a great lesson, and it's kind of an evergreen lesson, right? Whether it's 2008, 2016, whatever year, if you have some reserves, you can make it through, right? So that's really important. One way you look at that is having 24 months of all expenses. If you have that in the bank, that gives you the flexibility to navigate the market. And that's not including any operating income coming through the door. So it gives you a lot of flexibility. And that is a very conservative approach to that. Talk to me more about kind of, where you're at now with Harvard Grace and how you take kind of this reserve mentality and apply that to scale and kind of the current portfolio.
Well, Harvard Grace Capital is a sponsor and operator of stabilized cash flowing properties. Our goal is to deliver cash flow investments from day one to investors from good properties. They're fairly hard to come by. To be able to deliver, a minimum 5% cash on cash return to investors from day one, and that cash return would grow over time. So as I said, we're syndicators and operators. So we focus on the Tennessee Valley, as you call it. I specifically refer to it as the 840-565 corridor, and that refers to I-840 south of Nashville, down south through northern Alabama to I-565. So we're sandwiched in between these two highways, and the heartbeat of that is Huntsville, Alabama, which is a really hotbed of activity for the last 10 or 12 years. We target that area because there's a lot of opportunity. We live in that area. We will property manage everything that we do. And we do tend to focus on deals that are 15 million and under. And because of that, the real reason we property manage what we do is because we kind of think the third party property management model is broken, especially on smaller properties. And so that is the only way we've concluded to deliver on the business plan that we just sold the investors. So we do that ourselves. We do take the market property management fee, but we're not making any money on that. I mean, we're spending more than that with our staff, but we meet our targets and deliver and beat our projections and forecasts. So that's kind of what we're doing. We closed a medical office building deal last week in downtown Huntsville. We're in storage, and then we have an office building up south of Nashville in Spring Hill, Tennessee, inside that, just south of that I-840. All of these properties are doing very well, and we negotiate good prices. We don't have that many deals under management because it takes a long time to acquire a good cash flowing deal.
Yeah, you mentioned just play back, you acquire good properties in this area. You mentioned the 840 to the 565, 5% cash on cash from day one, primarily in Huntsville and kind of that surrounding area, looking at deals 15 million and under, and you kind of self-manage these assets. And you mentioned kind of medical office, some self-storage. Sounds like you're in a few different asset classes. What are the different asset classes that you're invested in today?
Primarily, it's those medical office, suburban office, certainly not Class A or Central Business District office. Um, we're probably leaning more towards storage these days. I know this is a multifamily podcast, and we follow the multifamily trends very closely because multifamily is the core. It drives everything real estate wise. And multifamily and storage is so closely correlated together that we have to understand that. Right now Huntsville has 14,653 apartment units under construction for a town of about 400,000. That's a lot, and the city has said whoa, sort of officially for a bit, but there'll be more, and so we follow it very closely. We haven't done any multifamily, and again, this comes back to knowing your investment philosophy. I've had 200 residential rentals of my own in the past, and I don't like that kind of management. And so I like following the multifamily trends, without the residential headaches that come along with it. Storage is like investing in multifamily without the toilets.
Yeah. I like what you said, and it makes sense now that you've kind of given that context, because when you were talking about the CPA business and like building it out and the staffing, and then you mentioned kind of, self-managing your portfolio, I'm like, man, that feels like a lot of, work. But, on the commercial side, when you talk about office and you're talking about self-storage, it's not the same level as with multifamily, right? You don't have to
Yeah.
have, 2, 3 property managers, 2, 3, maintenance technicians. You don't have to have all that on these assets. And some of them, the medical offices, I presume are either, triple net lease or double net, where, that resident or that tenant is responsible for a lot of those items. So, managing that becomes a lot easier when you don't have to deal with the actual maintenance portion of it. So that makes a lot of sense. And it also makes sense why you're being even more conservative on the reserves, because we know that an office building or some of these, not so much self-storage, but an office building, it could be vacant a little bit longer than maybe a multifamily community. So these are all good things to kind of just keep in mind and understand. And I like the fact that, going back to what we talked about earlier about kind of your investment strategy and kind of your risk tolerance, we can see how you've evolved over time, where you say, what, a lot of ins and outs dealing with residents. I'd rather focus on this. And I think that's really important for all of us to think about, is what is your investing portfolio? What is your investing philosophy? Like, what's your risk tolerance? And it's okay if that evolves and changes over time, especially as your situation changes. And I think you're a great example of that. For folks who want to maybe learn a little bit more about some of the deals that you've got going on at Harvard Grace, they can go to your website, harvardgracecapital.com. Tell us a little bit more about kind of what you see on the horizon and what they might expect from you moving forward.
We continue, even in this time of rising rates, to look for cash flowing deals, and it's a constant effort. We're not ever going to have 5 deals that we're working on at one time. We're heavily focused, but they will all be cash flowing. and which is getting harder and harder to come by, but that's okay, because if you find a good one in this environment, it's going to be even better a couple of years from now, as we think interest rates may come back down, and then you can refinance, pull some cash out, and keep on going, because you will have bought it at a higher cap rate, and when interest rates come back down, the cap rates will go lower too, making your asset more valuable. So we're looking at about 10 deals a week right now. I think we will have one to announce next week, when we come to terms. We're also keeping an eye out for perhaps real buying opportunities. If some of this $1 trillion of commercial refinances that are coming due in Q3 and Q4 of this year hit the market. I'm not counting on that, because I'm not sure how many properties are going to be in trouble in our target area. This is a very, very healthy area. At the end of the day, all real estate is local. And yeah, I talk to investors every day who say, "You do office? Like, are you crazy?" And so, all my office buildings are full. I wish I had more of them, and that's just a credit to the areas of the country that we're. I'm not chasing any downtown office buildings in any city right now, because those are the ones that are going to be struggling. But there's still a lot of opportunity out there.
I love it, man. Stewart, I think, again, anyone, they can go to your website to learn a little bit more, harvardgracecapital.com. We're going to move on to a round of insights. Stewart, give me a failure or an apparent failure that set you up for later success.
Failure set me up. Well, the obvious one that we've talked about. I failed, and I failed big, but we've turned that around, and we're having great success these days by being diligent and disciplined in the way we are approaching deals. We're not doing any floating rate debt, so we've minimized our risk there. We have plenty of reserves, and so if I lose a big tenant or whatnot, that's not a nightmare scenario for us, because we've prepared for that. So preparation and diligence, I would say, is my lesson learned there.
Give me a digital or mobile resource you recommend for your business.
Honestly, may sound mundane and boring, but I like Microsoft Teams. It really helps me connect with the people, whether they're my employees or contractors. It keeps everybody on one page. You got the different channels, and you got all your files, and you can do your chats and video meetings through that whole. And it's on every device you could want it on.
All right. Give me the book you've recommended or gifted the most in the last year.
The book I've recommended the most in the last year is Traction, because even in real estate, you do need an organization around you, and it's a really good way to help you organize your organization and how you go about doing your business.
What's a daily habit that helps you stay focused on your goals?
I like sitting down with my wife before my kids get up in the morning, and we're both having coffee, and we're talking about what each other is doing that day, and that just sort of helps me stay focused on why I'm doing all of this to begin with, which is for my wife and my family, and that's my anchor, and that's my rock. Yeah.
All right. Give me your number one insight for commercial real estate investing.
Location. If it may be a great asset in the wrong location, then it's no longer a great asset.
Yeah, I love it. All right, let's lighten the mood. We know we talked a little about the Tennessee Valley and where you're at right now. Give me your favorite place to grab a bite to eat.
Oh, that would be, there are so many. Los Trojas Mexican restaurant.
All right. All right. Well, listen, we got a lot of great information from our conversation today. You know, Stuart, I appreciate you sharing just your story coming from kind of the professional world, being a CPA, 20 years, watching that Carlton Sheets infomercial for hundreds of times, and that 25th time or whatever it was, finally it connected with you, you ordered it, and that got you springboarded off into real estate. Fast forward, you had some great successes. Had that one loss, those condos, but learn from that, change your strategy up, made sure you work with plenty of reserves on deals moving forward, and you've been able to grow Harvard Grace Capital to the different properties that you have and manage today. Again, if anybody wants to learn more about Harvard Grace Capital or Stewart, you can go to his website, harvardgracecapital.com. I want to thank you again, Stuart, for coming on the show today. You've been a great guest. I hope you have a great one. Take care.
Thank you, John. It's been an honor.